Joining me now, Sara Naison-Tarajano, head of private wealth management at Goldman Sachs, with a very big focus on family office. Welcome back.
Thanks for having me.
So you just had a big meeting. 200 institutional family offices from around the world, 17 countries and 80 cities. So you got a great cross-section view of what the world thinks about stocks. Is it easier to make the bullish case today or harder, given where the market's gone to and where valuations are?
Look, we had a lot of family offices there. And one thing I'll say, across the board was a greater interest in public markets. And I think that's not surprising, given the dislocation we saw on April 2nd. And so clients are very engaged in public markets. I think you can continue to make a bull case for equities, and I'm still quite bullish, particularly U.S. equities.
Okay.
What I'll say about that, though, is with vol really coming back in, and the VIX hit 16 this week. People are also looking at hedging strategies, which, I think is logical given some of the political uncertainty, the policy uncertainty. But I think there's still a case for bullish U.S. equities. I mean, we talked about the broadening last time I was here, and we definitely have seen some outperformance from the 493. They're up close to 5% year to date versus the Mag 7 up just about 2%. And Mag 7 posted, a really fantastic first quarter. And given we're at the sort of the tip of the iceberg on AI innovation, I'm still bullish these stocks.
I mean, there are some who, and we just talked to one, who thinks you're going to get a reversion to the small again. The small group is just going to lead the way because they proved it. The AI supercycle and the earnings that you just cited yourself are going to be reasons why everybody just goes back and continues to ride those stocks.
Yeah, I would not bet against the Mag 7 right now. I think, 28% earnings growth versus the rest of the market at 8%. And then keeping in mind you've got, mutual funds underweight by about 7%. That's an interesting tailwind as well. And then, and I heard others on your show talking about this, really kind of the first stage of what is an AI revolution. I don't know if it means you need to pick one or the other. I think you can be long the index and then, think about adding exposure accordingly to these stocks.
What about the idea, as Brad Gerster told me on halftime, about sort of the big bullish case? These are my words, not his, but being delayed, not denied. Is what you came into the year thinking was going to happen is still going to happen. It just got pushed because the tariffs were a lot steeper than people expected that they would be. Maybe the battle over the big, beautiful bill is going to be a little messier than people thought. But it's all going to happen. The tariffs aren't going to nearly be what they were on the big board on April 2nd. And you're going to get M&A. You're going to get IPOs. You got the super cycle, you said. Earnings surprise to the upside. Valuation, you can make an argument, is justified as a result of that. So it was just delayed. It wasn't denied, and we're about to realize all that.
Yeah, I don't disagree. I mean, I think you see capital markets activity. We've had 10 IPOs in the last month, and they're trading fantastic. So you've got positive capital markets activity, a resilient equity market, fantastic earnings. At the end of the day, earnings are really what drive growth in valuation here. And I think, the negative case would be a surprise around effective tariff rates, right? If we end up with higher effective tariff rates than anticipated, that's obviously a potential negative surprise, geopolitical risk. But barring any of those, I think he's right. We might get some blips. I think it's more about owning these stocks for the long term, which is how most of our clients think. They want to be long these stocks for years, for cycles.
VIX, you mentioned it, 16. It's at 17.
Yeah.
Ooh, oh my gosh, the VIX is so high. You think people are too complacent about the risks that are still out there? Like you said, what if effective tariff rates are higher? What if, the labor market starts to unravel? And what if inflation remains high because of the tariffs? What do you think about that? Too complacent.
Listen, I don't think most of our clients are that complacent. I think they're aware of the risks. They understand, CPI came in softer than expected. They think there's a possibility that looks different, in the back when tariffs are put into place. And so they're aware of these risks. But I think it doesn't change their desire to generally be risk on, to know that being long equities over cycles tends to outperform inflation. It's very hard to time it to come out and come back in. So for those who are anxious, that's where we say think about hedges, right? I mean, there's a way to deal with that without, taking a tax gain and changing the nature of your portfolio. So I don't think clients are complacent, and I think they're just kind of riding through this, and we'll observe what happens and act accordingly.